Back here, tuned into Bazaar Morning Call. Hope you're having a good morning. Well, time for some exclusive opinion then. Timothy Moore, Chief Asia Pacific Strategist at Goldman Sachs, says that 2 more RBI hikes are pending and could be of 20 basis points each. Yesterday, we spoke with him on the India market outlook, and we began by asking him if the worst of inflation and high yields is yet to be seen. Let's hear out what he had to tell us.
Well, we may have seen the worst of inflation, but we think, maybe following on Director Das's comments, that we are expecting 2 more 25 basis point hikes for the RBI to have a peak repo rate of 6.75%. So we still think there's a little bit further tightening that we have to go, even if the sort of inflation is crested. There still needs to be further tightening of monetary policy in order to make sure that inflation continues to subside. And if I could just extend that comment one point further, I think you mentioned in your question that there's an issue with valuations if we get straight to the equity market. We are very, very optimistic about the prospects fundamentally in terms of growth and in terms of earnings and so forth in absolute terms and also in comparison to other markets in the region. But the valuations are elevated just given India's tremendous success in terms of how the equity market is done. So that plus further increases in rates suggests that it may be challenging for India to continue to outperform to the same extent that it did this year. Hence our market weighting for within a regional context.
You know, I was going through your note where you are bullish on India's long-term prospects, but you're wary of high valuations. And that seems to be the concern, not just particularly to India, but even if you compare it to peers like, say, China or other emerging markets. In that context, what would the ideal strategy be for an equity market investor here in India for 2023?
I'd say that I really want to differentiate our views. I guess in a simple context, we could say that the longer-term strategic prospects for India and for the Indian stock market, we think are actually among the best, if not the best, in Asia. Just to give a couple of numbers here, our long-term view on GDP growth for India at 6% or a bit above is one of the highest, if not the highest, in the region. You asked about China, and our longer-term view there is more like 4% GDP growth and probably maybe some downward pressure there. So I think there's a gap opening up between the potential growth rates for these two very large and very populous economies. Now, in terms of how the market's done and how things are priced, that's where things get a little bit more challenging for equity investors because, of course, equity markets are about both the fundamentals, but also about how much is priced into them. And in India's case, the fundamentals are excellent. We have 15% EPS growth for this coming year and for 2024 as well. And that compound 15% growth is actually among the highest that we will see in the region. We're actually looking for declines in parts of North Asia next year in 2023. Because of their greater reliance on the global, sort of the greater global cyclicality and sensitivity, and also very high concentration in the semiconductor space. And then there'll be a strong recovery in 2024, we think, but the compound growth will certainly be somewhat lower than what we're expecting for India. So I think on a fundamental basis, from earnings standpoint, India is really one of the leaders. That being said, there's also a question of how much you're paying for that. And here I think that the nod has to go towards some of the North Asian markets, particularly China and Korea. And just to give, again, a bit of enumeration of this, India is currently trading in round numbers at about 22 times forward earnings. That's at the very high end of its 20-year valuation range. It was at a 90% premium to the region, with China having rallied in November. That premium has come down, but it's still at the high end of its longer-term range at about 70%.
In terms of individual sectors or pockets of interest, where do you see both valuation as well as growth headroom, particularly for India?
Well, within the market, we've got some very clear views, which we've expressed in a recent reports. Just to single out a few things, we're very much encouraged on the banks. There's just we think, a terrific story, and our bank analyst in Mumbai, Rahul Jain, has been very clear about his views there. I think the key story is that we are seeing clearly a recovery in private credit issuance and private credit demand. The increase in rates that we've seen suggests that margins are still still have some potential to expand. And additionally, we are at the early stage of any sort of a credit cycle, so we're not at all worried about significant write-offs. So it's a pretty powerful combination of opportunities, we think, for the banks. So we're certainly very favorable there. On the insurance sector, we have also significant positive views, and then I'd say we have a broader positive view on the industrial cyclicals, again, because of this recovery in investment and the need for continued investment in India. So we think there's lots of opportunity at the more micro level when you start to drill down into the different sectors and the different themes.
Okay, and cement would be a part of that? I mean, you like that space as well?
Absolutely.
Yeah.
I didn't want to enumerate everything, but definitely cement is there, and we've reaffirmed that. I was just in Mumbai last week. We had our India Chief Investment Officer conference there, and spent time with our analysts and with various business leaders, and certainly that cement, all part of that supply chain for infrastructure investment and development, we think is generally looks very attractive.
All right, that's Timothy Moore of Goldman Sachs.